Well, hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to a belated Friday mailbag edition of of our show, Chart This with Dave Keller. We're coming to you from Traverse City, Michigan. We're in northern Michigan, visiting my daughter. I had a choice last night: stay in the hotel room and do the market recap or do the mailbag episode, or go to my daughter's orchestra concert. I went with option B, which was a wonderful experience, and it was awesome to see her, and she played well. But I appreciate your patience as I get you the weekly mailbag episode Saturday morning. Hope you guys are all doing well. Hope you have a great weekend, and I hope this show gives you a quick rundown of what happened on Friday's session, but also gives you some things to think about as we pursue our ongoing efforts to help you make better decisions, help you be better informed, and improve your market awareness, which I would argue is the biggest challenge for a lot of investors. It's not about having a crystal ball that's more polished and better than someone else's. Is about having good market awareness. It's about having consistent processes of evaluating market conditions and just not missing what I would argue can often be clear signals of changes in direction, of key inflection points, and just strong trends that we want to participate in. A number of the questions actually tease on that idea of processes and how we actually navigate some of those different market phases. Before we get to those questions, though, we'll go through a couple market charts here just to update on what happened. Friday's session was really technology and then everything else. It was growth over value, not as much offense over defense because a number of defensive sectors actually did pretty well, but the S&P 500 did finish higher, and that's after a Thursday sloppy, choppy session with that V-shaped bottom in the afternoon. Friday was all about just a nice acceleration through the course of the day. S&P closes at 7165. That's a strong move to the upside, arguably completing the rotation out of that congestion area we had been talking about. The Dow, basically spent the entire session underwater and just finished slightly below zero. The Nasdaq, however, really doing the best effort on the upside, up 1.6%. Mid caps and small caps all up, all lagging behind the S&P and the Nasdaq. Volatility remaining in a low volatility environment. If you remember Thursday's show, we had a flash above 20 during the day on Thursday as the market had sold off there around news around the Middle East. Friday, sort of an all is well reading by volatility. And again, the VIX finishing the week below 19. That's a pretty good place to be. Rates generally drifted a bit lower here. The 10-year yield finished the week just above 4.3%. The dollar came down a bit after spending much of the week sort of grinding higher. Bonds were slightly higher as well. In the commodity space, the big, I would say, news would be the fact that crude oil and other energy prices came down. That's part of that, equities doing better thesis. You had crude oil down. You had gold and silver, the precious metals, finishing higher with GLD up about 0.5%. Finally, cryptocurrencies. It's been a choppy couple sessions. We're kind of the last couple of days, we've been right around 78,000. We're just slightly below that right now as we're doing this Saturday morning Eastern time with Bitcoin just above 77,600. Generally, cryptocurrencies have been kind of choppy here over the last couple of days. We'll see what happens over the weekend and particularly next week. If there's news flow from abroad over the weekend, that's Bitcoin and Ethereum can be one of those ways we get an instant reaction before the futures market really pick up on Sunday evening Eastern time. In terms of sectors, as I mentioned, it was pretty much technology and then everything else. Consumer discretionary did okay also. The XLK, which is technology, was up 2.8%. That's obviously a big improvement relative to other sectors. Consumer discretionary up 0.8%. Materials and utilities were basically slightly above zero. On the downside, heavy movement to the downside in communication services, with the XLC down 1.6%, healthcare down 1.4%, industrials down 0.9%. We're going to dig into a lot of those, market-related themes and also the meaning of this narrow leadership in technology in our weekly flight plan. And as a reminder, that's a report that's only for our Market Misbehavior Premium members. So I would implore you, if you enjoy what we're doing on the show here and you're ready to take those next meaningful steps, from Dave randomly talking to you on the Market Recap Show to Dave really helping you improve your process and hopefully improve your returns, especially your consistency. You want to check out our Market Misbehavior Premium memberships. You can check that out at marketmisbehavior.com/premium. includes virtual courses to teach you all about technical analysis. It includes research reports like our weekly flight plan and our monthly chart review. Also, a really cool community where you can ask questions, you can learn from other investors. It's a really fun, supportive group with a lot of great ideas flying around. We'd love to have you be part of that as it grows. Find more info at marketmisbehavior.com/premium. Don't forget to use the code YouTube when you check out. That'll give you 30% off your first 12 months. I'd hope to see some of you join there this weekend, won't you? All right, just to finish off on the quick market recap, NVIDIA up over 4%, Amazon up 3.5%, Meta up 2.4%, Microsoft up 2.1%. Those four stocks, I would argue, are the reason why you saw technology up a ton. I mean, it's others beyond NVIDIA, but that is an example of the move that you had in technology. Amazon up 3.5%, certainly helping the consumer discretionary sector. Communication services, I would say Meta is certainly a positive outlier, having a pretty good day there relative to others in that sector. That was the weakest S&P sector. Just checking in on the charts here really quick. So we talked about the sort of sideways consolidation area in the last week for the S&P. This was last Friday, right? A Friday week ago, where we had that big gap higher. And then we just sort of stalled out through Thursday. Friday was a nice sort of breakout move. And I think that close above 7150 for the first time, clearing those what we call high upper shadows from a couple of days in the last week. Could be a meaningful breakout. It's all about Monday if we get that follow through. But for now, I would say that's a pretty encouraging way to finish the week by far. Some of the breadth readings, though, not particularly strong. And so what we're seeing here is this is the percent of stocks above their 50-day moving average. It was around 62% last week. Now it's down to around 52, 53%. So what's happening is the S&P is breaking out, the Nasdaq is breaking out, but technology was really the main driver there, especially on Friday's session, sort of dwarfed the returns of the other sectors. So we're getting back to some narrow leadership. That's often one of the warning signs that I've detected is the market breaking higher on weaker breadth. That's foreshadowing of one of the questions we're going to entertain here in a little bit. So, risk measures, I would say not all of them breaking out on Friday. A lot of them kind of ticking lower. So not a completely all clear. But again, what's most important is price. Price for now appears to be breaking out. All right. We're going to take some questions. As a reminder, these are questions that came from viewers like you just over the last week. If, as you're watching the market recap show, if you're watching any of my content in other places, if you have a question, please share it when you can. During our live stream, you can ask questions as we go. On our YouTube channel, you can always use the comment section. I read every comment that comes in and certainly looking for your questions. So we'd love to answer one of your questions in next week's mailbag episode. All right, I did get a number of questions on relative strength. This actually came from our webcast last week. The webcast is at marketmisbehavior.com/leaders with an S. We talked about how to identify emerging leaders. We talked about scans. We talked about relative strength. It's kind of an interesting mix-up of different topics, but appeared to be pretty well received. I got a lot of great feedback on that. You can still watch the replay through the end of the month if you go to marketmisbehavior.com/leaders. So I hope you can check that out if you want to learn more about that. But this was a question that actually came during the live stream there. I'd like to use the relative strength tied to SPX indicator on stock charts you mentioned yesterday. And you mentioned you're a stock chart subscriber, but I can't seem to find it. Can you help? I definitely can help. One thing I've tried not to be is the stock charts and other charting platforms help desk, because I do have other things I need to do, but this is what I'm happy to answer because it's a pretty straightforward one. So on stock charts, if you bring up a chart, below here, you're going to go to the indicator section. And this right here is what you want to do. There's an indicator right at the top. There's a section called comparison. It has price performance. That's the one that you want. And then the syntax here under parameters, it has two things. So it's going to be the thing on the left versus the thing on the right. So I always have the SPY as the thing on the right because that's sort of the standard benchmark. It includes dividends, which is kind of how I generally want to evaluate charts. So that's why I use the SPY. On the left, you just want to do $ symbol, okay? And when you do $ symbol, it's automatically, whatever ticker you type, it's going to make that the numerator in the relative strength comparison, right? Now, other charting platforms, to be clear, good charting platforms have this capability. I've seen it called different things on every different platform. There's no really consistent way that charting platforms, sort of represent this particular thing. But every good charting platform I've used gives you the ability to compare a stock to a benchmark. So, like on Optima, it's called relative index comparison. On Bloomberg, it's called, I think it's just called a ratio, to be honest with you. I think you just do a ratio chart. It might be called relative strength, though. Um, some platforms, it's called relative performance or true relative performance. That's how I think on Koifin, it's something like that. So you want to look for something with the keyword like relative, and that'll probably get you pretty close to the same place. And I should mention on the IBD stuff, like Market Gauge, they have a relative, they call it the relative strength ranking, or so relative ranking, because they do it as a percentile ranking. The idea is you just want some way to compare what you're seeing on this chart versus all the other charts you could be looking at. And as we talked about in the webcast, and if you miss it, please go back and review it, because there's a lot of good insights on how to use this methodology. But the idea is relative strength in terms of what we're talking about here, relative to the S&P. That's our report card. So when we buy stocks, we want to make sure that that line is going up. And if we buy stocks and the line is going down, that just tells you that we're not in the right chart, most likely, right? There are some charts, some other chart somewhere else is probably outperforming. So let's continue to find those charts that are outperforming. So that is that's the way to do it. Hope that helps answer your question. And let's go on. Technical analysis has a role interpreting market moves driven by market forces, market in capital M, I'm noting. It is not clear that technical analysis has much of a role interpreting market moves driven by war or other natural disasters. Got a number of questions along these lines, and I appreciate that very much. Sort of a philosophical question, right? What's the point of charts when everything's driven by sort of non-market forces, right? Here's the thing. I would argue everything's driven by market forces, right? And whether the buys and sells that we interpret on the charts are driven by concerns about a conflict in the Middle East, excitement about companies raising their earnings estimates or their earnings guidance, just pure supply and demand and how that's shifting. The one consistent thing in all of those different scenarios is that the price is going to reflect what investors are thinking. And investors are excited or nervous or panicked or euphoric about whatever it is. The price is going to go up or down as a result. That's one of, I think, the basic premises of charts, is that the price means something, right? John Murphy would say that it reflects all known information, right? The price actually reflects the aggregate opinion of all the market participants at any given time, because if it's wrong, then the prices will shift because people want to buy or sell to express that optimism or pessimism or whatever it is. So one could argue, and I am making that argument, I would say price matters quite a ton. Now, what you're implying is, like, what about these big gaps that aren't like a technical gap, right? It's not a technical reason this happens. It's a big move higher, 100%. And I think that is the reality of investing in any part of the environment at this point, right? In any asset class, you are exposing yourself to different risks, and that's how I think of it, right? When you take your money out of your mattress, out of cash, and you put it in anything, in a bond, in some specific currency, bet, in a cryptocurrency, in a stock or ETF, in a commodity, you are taking on risk, right? You are asking for greater return. Otherwise, you just leave it in your mattress. You are gaining the opportunity to increase the value of that capital. But the way that you're being compensated for the fact that you're taking on additional risks. And I think that's something I learned to embrace in my institutional years working at big financial institutions. Was we thought a lot about risks, right? And if we buy the stock, like, what risks are we taking on? Well, we're taking on event risk, right? Something happens out of nowhere. We're taking on macroeconomic risk, that some indicator shifts that causes this equity to be, change in valuation. Change in interest rates completely changes the value of future earnings according to the standard methodology. So interest rates are pretty crucial. You're taking on currency risk a lot of times if you're buying a non-US stock, because the strength or weakness of the dollar can impact your investment. You're taking on earnings risk. You're taking on headline risk. You're taking on volatility risk, which is just the normal market noise. So those are all risks that we take on when we buy a stock or ETF. So we have to acknowledge that when we buy a stock, there's a chance that the stock gaps higher or lower on any given day because of earnings, because of a management change, because of some news event that affects the company, because of some macro event that really isn't directly tied to the company, but it's going to affect the broader economic conditions under which that company is going to operate. So I guess that's how I would think of it, right? Number one, these are acceptable risks, or else you shouldn't be investing at all. You have to understand that that's part of the game, is that those risks are there, especially with equities. You have earnings, which often provide a binary outcome for a stock. Um, but the benefits, right? And this is the key, right? Even with all the crazy events, if you look back just in the 26 years I've been doing this, there have been so many crazy and arguably very unpredictable moments that have occurred from, I mean, just so many more, I mean, crises and crazy bull markets and bubbles bursting and recoveries, and all of those things happen. Greater regulation, lighter regulation, crazy stuff. But the market made a new all-time high on Friday. So what we have to remember is the general trend in equities is higher despite all the craziness that we have already experienced as human beings. And with all the craziness, I would argue we're probably going to continue to experience as human beings. There will be a lot of drawdowns, there will be a lot of corrections, but generally the market's going to move higher. Indeed, the market has recovered from 100% of market corrections. So that was a long-winded way of saying, hey, I hear you. Events happen, and technical analysis is not meant to predict anything, I would argue. It's meant to interpret investor psychology driven by all those other things that you mentioned and many, many more. And I believe it still has great value. All right, let's get to another question here. Sorry, just moving a thing around. All right, next question. You mentioned scanning for charts that are making new 3-month highs, but could you expand on the things you look for once you have that list of charts? Also, how often do you check that list? Daily? Thanks so much for asking that question. So the short answer is I do run the scan daily. The question is, do I look at it daily? And the answer is absolutely not. I have found, as a technical analyst in 2026, I have way more tools and systems than are really needed, right? I mean, I have way more capabilities, I should say, than you really need, right? In terms of staying on top of things. And so I set up a daily scan years ago on stock charts to every day email me a list of stocks making new 3-month highs and a list of stocks making new 3-month lows. And during certain market conditions, particularly when I'm like, look, I'm really, keen on finding some new breakouts, I will probably look at that list every day. Other times, I kind of am not having trouble surfacing ideas just through the normal process of what I do, where I'm often looking at hundreds of charts a day. So I don't pay as much attention to it. I have one day a week, Wednesdays, when I usually, I make a point of looking at the scans and just thinking about what's happening kind of midweek, because my main effort is my weekly process. I do that over the weekend. That results in my weekly flight plan, as I mentioned earlier, that goes to my premium members. So weekly over the weekend is when I really do the bulk of my meaningful, okay, this is really how, these are changes I need to make in my thinking because of how the evidence has shifted. Midweek, I'm kind of incrementally adding to augmenting that effort that I made over the weekend, right? It's just sort of gathering new data to see how closely the market is lining up with the expectations that I set in my weekly report. And so Wednesday is a great time to check in kind of midweek and just say, all right, am I on top of all the stocks breaking out and all the top stake breaking down? Now, you made a great point, which is, do I just, are those lists just bullish? Do I just buy those stocks? And the answer is definitely not. So there's two different ways, two general approaches I have found to running scans. And I'm not going to get too much into how I'm setting up the scan, but basically this argument right here. We're going to look at the S&P 500, and this is, I want a close higher than the last 13 weekly closes. So as of Friday's close, 70 names out of the S&P 500 made a new weekly closing high last week. And I usually group it by sector and then industry, and I save it to a chart list, and I start at the top and I start flicking through them. To your point, though, would I just blindly buy this list? Absolutely not. Because for me, oh, sorry, what I meant to say with scans, there's two kind of general ways you can think about it, right? Way one is get a very specific scan. I'm looking for this very specific combination of indicators that when they fire, I have a high probability that if I just buy that group of stocks, they're probably going to do pretty well. So that is a scan with a lot of different criteria that is looking for a very particular configuration. Often you might have zero, maybe a couple results at most, but the goal is not to have a ton of charts to look at, is to have a very small list of kind of the ideal charts. I don't tend to do chart scans that way, and a lot of people try to, I think, over optimize scans. For me, the point of scanning is not to get to the final answer, it's to get a working list to go through. And so one of the things I found years ago was if I just scan for stocks making new 3-month highs, I'm going to be on top of that. And that comes from a couple analysts whose work I followed very closely in my Fidelity days. One is Nick Glyden from Redburn Partners, who would generate this fantastic list. He has a wide following in the institutional community, and he would generate these lists of stocks making new 1-month highs, new 12-month highs, and I believe occasionally 3-month highs. And that might have been part of the main list. I forget now, but that that was always a great list of charts to be aware of, and I never forgot that. And the other was Rob Slimer, who was at a couple different firms, but has been at Fundstrat for a while. And Rob did a really good job of. He was at RBC before that. He would always do a really good job. He had this really good visualization that would only, out of this big universe, we would only look at stocks making new relative highs and lows, and found that was a really interesting list. And Nick Lydens was on relative highs and lows as well. So for me, that idea of just looking for breakouts and breakdowns, I really started to pick up on the benefits of that approach. Of just ignoring all the charts that were kind of in the middle and just focusing on the barbells, the ones really having meaningful moves. So this list of charts, I literally do what I'm showing you here, which is I come up with that list, and I usually have a piece of paper and I jot down, okay, Amazon clear breakout, that's good to know. MGM, really starting to grind higher, but more of a slow volatility move. Airbnb breakout, now a pullback to support. That's an interesting chart to keep an eye on. Casey's is just a long and strong uptrend. And I usually start sketching out the patterns and jotting down the tickers in each of them. And that's been something that I've done for a while. And once I started doing that, once I included that in my process, number one, I tended to find actionable ideas, because I would be able to see, here are the stocks breaking out, but these are the ones that are really at the appropriate point. And that was another part of your question. Would I buy a stock at its breakout? Potentially. Would I wait for a pullback? Potentially. And this is why I think it's a little more one-off analysis, right? My ideal chart would be a long-term uptrend and we're pulling back to some sort of support level. That's sort of my ideal situation I'm usually looking for. But when things aren't ideal, I'm looking for charts that are going higher. And generally, just following charts that are in uptrends has never steered me in the wrong way. Great question there. We're going to continue on with a couple more questions that came from you guys. Before we do so, quick shout out to one of our partners, Seeking Alpha. They have a great product called Alpha Picks. If you go to marketmisbehavior.com/alpha picks, you can learn more about their methodology where they use their quantitative model. They look for strong buy rated names in that universe, and then they hand select just a couple names a month to dig into a little bit deeper, and they feature those stocks as alpha picks. Over time, the performance of this basket of stocks has done remarkably well and has outperformed the S&P. As always, past performance is no guarantee of future results, but I have really enjoyed keeping an eye on those alpha picks. It has never disappointed in terms of surfacing interesting ideas that I'm happy to be aware of. Again, you can find out more info at marketmisbehavior.com/alpha picks. They're offering $50 off their annual service, which is about a 10% discount, which is pretty awesome. You can get that at my link, marketmisbehavior.com/alpha picks. I hope you will check them out soon. All right, continuing off, we got a couple more questions here. The markets have successfully wrong-footed the bears again. How many V-bottom reversals have we seen recently? Continue to stay long over long time periods is the simple takeaway. What I love about your question, by the way, is you've done a fantastic and classic behavioral thing, which is personifying the market. Right, the market is not a inanimate object. It is a living, breathing organism, right? That has successfully wrong-footed the bears. Just the phrasing of your question reinforces how many of us think of the market as this thing, and some even refer to it. I randomly will call it Mr. Market. Analysts and mentors that I followed have called it Mr. Market. The late Hank Pruden, fantastic author and educator, used to call it the composite man, as this being that was the composite of all the market participants. And it's interesting when you think of it that way. You're personifying this inanimate thing, this mythical market being. And as a result, I think that affects your behavioral approach, right? When we think of it as a human being that's wrong-footing us, then all of a sudden we want revenge, right? We want to get back at the market for being so mean, and that can lead us to some dangerous places. So I don't think you're in dangerous psychological territory. I just wanted to point out that is a common way that we think about the market, as a sort of personifying an inanimate object. Just wanted to point that out. So how many V-bottom reversals have we seen recently? Too many, right? Too many. We even saw one just on Thursday's session. We saw a V-bottom. So I think the answer to your question is embedded in the question. Continue to stay long over long time periods is the simple takeaway. Here's the thing, right? I think to answer your question, look at a big long-term chart of the S&P 500. We'll look at a weekly chart, and we'll go back like 20 years, okay? There have been a bunch of drawdowns. So 20 years has taken us back to 2006. There have been a bunch of drawdowns. I mean, and some of these have been, long grinds lower. And if you're looking back over the last 20 years, right, 2022, certainly the most recent example of a big, protracted, multi-month, I mean, that was months of lower highs and lower lows, took forever, right? I mean, compared to pullbacks that we've seen in the last couple of years, in the post-COVID era, that's the only real kind of classic bear market. And if you look further left, you'll see like 2015 and early 2016 was a long cyclical bear market. Even these pullbacks, like in 2011 and 2010, those are 6-month pullbacks where we really gave back a lot of gains before we finally recovered. But you have to go back to like the financial crisis for the long, anything that's longer than that 2022 pullback. Now, having said that, you have all these other little quick V-shaped bottoms. And I think the taper tantrum from 2025, most recently, this Iran war shock, which, was very, very short-lived. I mean, that's the reality. What gives with that? I would say the dynamics of the market are changing for sure. I mean, I'm definitely observing more of those V bottoms than ever. I remember specifically, this was the first V bottom that I distinctly remember. Now, the market had been going down for a year, to be clear. But when it finally sold off in the first quarter of 09 and that March 09 low, and then we rallied so heavily off there, I remember being completely off guard with that. And I was at Fidelity at the time, and I remember talking to a number of the portfolio managers just about the strength of that rally, the fact that banks were just ripping higher after getting absolutely demolished. So banks led the way out there for the first couple of months. It was a crazy period. And for me, it was a big wake-up call on, okay, the market can actually have a V bottom, because the bottoms I'd experienced were like the 2001, 2002, which is kind of a grind. And so this was a significant, quick, and abrupt turn. And so for me, I'm always kind of thinking, when we have a big sell-off, like a V bottom is actually pretty likely of an outcome these days, as opposed to a long, drawn-out sort of bear market phase. So what do you do about this? Well, part of looking at the long-term weekly chart is to recognize that whether or not the corrections have been, long and protracted, or short and abrupt, we've gotten through them, right? And the market has literally recovered from 100% of the corrections in market history. And those have been big, over a year corrections, like the great financial crisis. Those have been quick blips, like the COVID sell-off in the beginning of 2020. I mean, the market has recovered from all of those, and it's usually done so in a very, relatively short period of time, particularly in more recent history. So generally speaking, during big cyclical bear markets, you really want to be thinking, if you have a long-term time frame, you really want to be thinking of being a buyer. And that's why it's important, I would argue, to sell off as early as possible, to raise cash earlier in the sell-off. So when we do get that 30% off coupon on the markets, we have cash available to put back to work and buy in low, right? You don't have that cash available unless you've been lightening up on positions when we're in a position of strength, or when we start to show signs of weakness. So I think that's an important thing to remember is that the market has recovered from everything. So generally thinking as a buyer, recognizing that any sort of corrective move is going to give you an opportunity to buy in at a much lower level because the market is always recovered from corrections. I think that's an important thing to remember. That's why I always caution people playing the short side of the market can be profitable, but only at very short periods of time, right? Staying short the S&P, staying short the Nasdaq has never worked. It literally has never worked. It's worked in a short period of time, often like a couple weeks, at most like a year. But beyond that, the markets just don't stay in cyclical bear markets long enough for a long time short position to ever be a good idea. So playing the short side is a quick tactical move, I've learned. Generally the market's going higher. Now, at some point, maybe we enter a big secular bear market and that completely changes. But for most of my career, certainly post financial crisis of '09, market's been generally trending higher. And so that's I think one thing to remember. So V bottoms I think starting to become the norm and not the exception. I think to your point. Do you have any thoughts on the RSI divergence that's showing up on the weekly S&P and Nasdaq charts? When do you start taking that into account? I happen to have a weekly chart right here. Let's zoom in a little bit. Yeah, I see what you're talking about here. Here's the RSI divergence right here. This is MACD and PPO also flashing a divergence. So what do you make of this divergence? So here's the problem I have with weekly divergences. And I should point out, by the way, this question actually came from one of my premium members. This came from our member community. So I get questions like this all the time. I'm answering them all the time. And we would love to have you as a premium member. You can ask questions there too. Again, that's at marketmisbehavior.com/premium. And would love to answer your questions there. Use the code YouTube when you check out. I shouldn't be multitasking that much, but you get the idea. So I've highlighted a couple different examples here, right? So the problem I have right now, this is one of those big long-term bearish divergences. This is a bearish divergence that arguably has been going for about 6 months. So with a weekly time frame, with a weekly RSI, divergences of this scale, I don't find particularly helpful because they often happen if the market grinds higher for an extended period of time. You often start to get those divergences, and one that kind of persists for a while. It no longer is just a great. For me, it's a warning sign, but it doesn't really compel me to take action. The break, right? The break of a key moving average. This is when the S&P broke the 200-day. A divergence on the daily chart, which represents a short-term shift in momentum. Those are the things that I found are much more actionable. Divergences on the weekly chart just can last a lot longer, particularly bearish divergences in a bull market, right? So as the market's going higher, you will often find indicators will diverge and they'll just stay divergent. I mean, look at how much this is 9 months that the PPO was trending downwards before the top actually occurred. So knowing back here in April of 21 that there's a divergence and 8 months later it's going to maybe suggest a top, like I just don't know how much that adds to my analysis in April. So I've tend to ignore them. This sort of divergence that you see in like the fourth quarter of 2021, that one is kind of interesting because it's a much shorter term time frame. That's a divergence that shows up on the daily chart too. So I would say a divergence of like a couple weeks to a couple months, pretty meaningful. And that's on the daily chart. The weekly divergences, if you look back at time, there have been plenty of times where you have these big, long uptrends and some indicators probably diverging. And I don't know how much that adds a ton. And I've just learned it happens a lot because the momentum on the weekly chart often will not be that severe, particularly during a low volatility uptrend, which is what we are arguably seeing right about now. All right, last question, then we got to call it. Thank you for the continuing education. You're welcome. And I think that's a great way to describe what we do here. I'm assuming that you have a basic understanding of these concepts, and I hope that what we do on the show reinforces some of the lessons we want to remember. As I believe we are approaching an intermediate market top, what have you found to be the most effective and most reliable leading indicators? Well, as we just established, it's not weekly divergences. So let's get to what it might be. So there are two kind of classic leading indicators that I've often found are really helpful, and I might throw a third in there. Number one would be bearish divergence on the daily chart, right? So on the daily chart of the S&P 500, I have often found some, let me get rid of this thing on the bottom. I've often found divergences to be pretty helpful. Like, so here is December, January, February of 2024 to 2025. Pretty classic bearish divergence that indicated we might be near a top. That was pretty helpful. These new highs that were on weaker RSI, I think were part of that. Part of that story at the beginning of this year, sort of implying some weakness. And if you go back to like major tops in 2007, in 2020, like the COVID top, classic bearish divergence. Those are some great ones to reflect on. Actually, I might have one or two of those queued up. Let me see. There we go. That's a great classic divergence. This is the 2020 market peak, January, February, higher highs in price, lower peaks in momentum. That's kind of the classic textbook bearish divergence that often occurs going into a major top. So that would be one. A divergence kind of looks like this one. The second thing would be breadth divergence, right? So the market making new highs on weaker breadth readings. I don't know if we're necessarily seeing that. Maybe a bit of that last week. We started, or this last week, we started to see some weakness. But things like the percent of stocks above their 50-day breaking below 50%. That's actually pretty close to happening here. It looks like. So that would be something I would be concerned about. The advanced decline lines not confirming a new high in the S&P and the Nasdaq. That would be another thing I would be looking for. So generally, yeah, markets moving higher on weaker momentum and or weaker breadth are two warning signs that I look for. The other one, obvious one, would be the VIX spiking above 20. That's usually a pretty good leading indicator. Tends to happen early on as a market has topped and just starts to rotate lower. Then I have a bunch of other things. I have a market top checklist, which if and when we get in that kind of environment where we start to see those signs, I will dust that one off and share it with you. We've done some webcasts on that before during opportune times, but I think that provides 7 steps, starting with those first two, breadth and momentum divergences, then goes through a bunch of other steps that I have found pretty consistent at major tops. We'll dig that out. I don't think it's the right time just yet, but I will certainly keep you informed when it is. Folks, that'll do it. Thanks so much for joining me here on the show today. Apologies for the late kickoff here, doing it the next morning, but that was the way I could fit it in. And I hope you have some time over the weekend to reflect on these questions and their answers. And I hope it gives you some ideas about how you can make some better decisions in the week to come. As a reminder, if this sort of improvement in your process, if you're ready to take a next meaningful step along that path, think about our premium memberships, marketmissbehavior.com/premium, and use the code YouTube. Otherwise, have a fantastic weekend. We'll be traveling back to Seattle on Monday, so no live show on Monday. However, we will be back live on Tuesday. In the meantime, have an awesome weekend. And remember, it's always a good time to own good charts. Take care, folks.